Hi, welcome to Smart Investor. My name is Ganesh. Today, we are going to discuss an interesting, most rewarding strategy. This strategy generally works very well at the current situation. We are going to discuss all the scenarios and why this strategy, what is this strategy, how does it work, and how I have been executing this strategy for the last few weeks. What are the profits are making and the returns of investment, all we are going to discuss. So this strategy name is nothing but all of us know that, but just I remind this strategy is called uh, put diagonal spread. I call it PDS, put diagonal spread, right? This spread is generally part of calendar spreads, right? When you say calendar spreads, which means what is a calendar spread? It is different expiries majorly, and strikes are the same or different strikes. Strikes are different and different expiries is called diagonal spread. Same strikes but different expiries is called calendar spread. This is a basically overview. So if you would like to know more details about this calendar spreads, all those things, in a playlist of calendar spread, there are several videos I have already recorded. So this video length will go high if I discuss again all those things. That is basically we need to understand. When do you use this calendar spread? Or when do you use this diagonal spread? All those things we are going to discuss. If you see, we all of us know that, right? So there is a major event going to happen in the month of June 4, right? So since that is a bigger event, the VIX would going to rise. So till the market finds certainty or results are out, VIX certainly is expected to go high, maybe 25, 28 or 30 plus or minus 2. That is what happened previous to the 19 election, 2014 election as well, and the month of election period. So that is also we expecting to happen same in the month of May and June. And also we all know that VIX one point of time, very few days ago, crashed to 10. From 10, it's already reached to 20 plus, I mean 21 also. So then when you say VIX is rising high, just what we need to understand is VIX is rising for the month of June, not month of May. This is a very important point to understand because the event happens or takes place in the month of June, not May. So options premiums of June are continue to go high with the proportional to VIX, and decay going to happen. Theta is positive for month of May, right? So current month of May options works as per the theta, but premiums of June would go high based on the VIX. This is the scenario currently we have. In this scenario, what is the best way we can work out? That is the strategy. I said put diagonal spread. Let me explain more in the. This is the VIX. We see this very recent how it has last few days. VIX fell to almost to 10 from 10 onwards. So VIX has risen to 20 plus 21 also. So since then it is above 20 for a few days. Maybe it is expected to be very high when we are closer to the event, maybe 28, 30 plus or minus 2. We don't know, but what we think this weeks still continue to go high due to the election. Then why this put diagonal spread? Why this strategy? If you see risk reward is very good, risk is very low and reward is very high. Why risk is very low? This is fully hedged. Number of options bought are equal to number of options sold. Only that delta higher than the sold option is there, that will be the loss. Otherwise, one leg is giving loss, another leg is supporting. This is the win-win scenario. So equal quantity. So while VIX continuously go high, bot option will help us to uh, balance this strategy. And what about margins requirement? It's very low because this is a debit spread, buy and sell.
So margin requirement is obviously very low. What is the range for this strategy? So generally, whenever we sell an option, we'll sell at the premium of 150, 130, 150 around that premium. So it gives hedge of 200 point minus to spot and a 200 point plus to spot. So spot minus plus or minus 200 points range. So totally we'll get 400 points range. This 400 points range is not for the month. The range is within a week. What are the rules to build this PDS? Very simple. We have to buy next month ITM option. Is 200 to 300 points in the money will go and buy. Next month means year contextually. June month options will go in the money. Will buy the put option. What will happen then? Sell weekly at the money put option. I'll show you how. What is that? So at the money to spot, we'll sell it. Then what are the simple adjustments? So I don't want to make it this complex. It's a very simple. When we are profitable in the sold option with the due to data, we'll book the profit and closer to the week, maybe on Wednesday, before Thursday, Wednesday or Tuesday, we'll see premium is very low. It falls to 20 rupees, 30 rupees. We'll roll over. Premium is there. Still, we'll wait for Thursday. Our premium is, I mean, maybe goes below our sold option. Sold option becomes in the money. We will wait by the Thursday. If it is loss, that's okay. The sold option gives loss, but bought option gives profit. That will be balanced and consolidated. Will not find much loss. We'll roll over to next week with a good premium. Again, at the money. ATM is selling option should be ATM. So we're keeping ATM sold and keeping 200 to 300 points in the money. So range we are getting around 400 points. So this is a neutral to slightly bullish or a slightly bearish. It works. This is a strategy works for this condition. Let's see the payoff chart for the put diagonal spread. What we have done is, as of now, spot is 22,500 as of closing of last Friday market, 22,500, right? So what happens? So 300 points in the money we are going. So we are selling put option of June month, 22,800 strike. It is getting the 650 rupees. And weekly option is at the money, right? So that is to 22,500. So we are selling this 22,500 for 150. So you see probability of the profit is showing 53% because since we have only 2 weeks in the month. If you start first week of the May, this probability would be very more. Right? It could be 8, 70, 80, 85% like that. And max profit, yeah, max profit, this is per lot, right? So max profit is 3,400 and max loss is, remember, 12,000, around 500. Yeah, when you see max loss, max profit, it appears like that. But reality, we do not find max profit, we do not get max loss because this payoff chart considers current expiry of the sold option as the final estimation while making. See, in bottom of the line, we see payoff will be dynamic in case of calendar strategies. It changes with the individual option leg IVs. So because of that, we cannot estimate exact max profit and max loss, but it's an estimation. But break even, see, 22,150 to 22,760 or 750. So we are getting 400 points range, which is very good. And estimation margin, just 15,000 for one lot. One lot means here 25, right? So as per new contract size. So just 15,000 we are getting means, I mean, that's where risk reward is very good. Low risk, high reward, lower margin it is expecting. Then people would ask, why put diagonal spread? Why not call diagonal spread? Should I also take call diagonal spread? Generally, this is a question. Let's see. I'll show you that. What is call diagonal spread? Same logic if you apply and take the payoff from the call diagonal spread. Values are like this, right? Values we see uh, 300 points inside, right? So then 22,200 call. We are getting for 800 rupees. There we got 650. Here it is getting 22,200. Uh, Sold option price is more or less the same. That's okay. More or less same. It will be always. But debit we are paying very high. That is why loss would also show you max loss is very high. There is a 12,000, here 15,000. More than, it's almost 5,000 more in call spread. Of course, break even, all other things remain the same. But since this is a basically PDS and CDS are the debit strategies, but profit and loss, max profit and max loss in CDS is more than PDS. And loss is more because this is a bullish market. Obviously, calls are very high, premiums it is available. As per the future price, this put option and call options are adjusted. That is the underlying reason. Okay, so that is why we choose um, put diagonal spread rather than call diagonal spread. That is one reason. Another reason is we know that from here market to go beyond 22,800, very unlikely, right? So it never crossed and stayed above 22,800 so far. From there again it corrected and came down below 22,000 also. So this range is expected to be at least by in the month of May 22,000 to 23,000. As long as it is running within this range, obviously we'll make a profit at one good point of time in a week or 2 weeks or 3 weeks. If we keep rolling over the sold option, we'll make good profit with less risk.
If you like the video, you feel this is useful to you, please do like button and if you not yet subscribed to this channel, please subscribe. It gives me more motivation to bring more such videos to help you to grow and learn together. Thank you for watching. Bye bye.